Traders, Cousin Vinny coming to you from theclosingprint.com on February the 2nd, 2020. In this edition of your weekend video newsletter, we'll discuss the stock market's survival with the China trade war, recession fears, tightening monetary policy, and now the coronavirus as catalysts. We've been running since October, reaching highs 2 weeks ago, and have since started to pull back 3.36% to date. Last week we saw the S&P pull back a little bit more than 2%, and the other indices followed. IWM fared the worst. All indices, including the Hang Seng Bombay and the Nikkei, were all lower last week. Most of the FANG stocks were lower, with the exception of Amazon off of earnings. We have Google with earnings this week after the close on Monday. Microsoft was higher on earnings, and Tesla followed through as well, finishing the week up 15%. Bond stock ratio is bearish. Dow Composite is bearish. The S&P 1500 is turning bearish, and the XII, our institutional index, is on a sell signal. Tick and TickQ both turned lower on Thursday and continued to trend in a bearish direction. NYMO and NAMO are near cycle lows. We could see that improve this week as the S&P 500 spiders trade near the 50-period moving average on Friday and bounced at the close. The put-call ratio did spike a bit higher last week. We could see that move up to the 120s, 130 zone if fear does continue higher. VIX spiked as a result up to 1999, then faded into the rest of the session with the bullish percent at 62%. SKU is moving lower at 130, but did bounce Thursday and Friday. US dollar was rejected at a descending channel. We'll need to keep an eye on that, especially if you're trading commodities. Gold has been grinding higher along its 9 EMA. It's bullish. And copper has had a waterfall event over the last 2 weeks straight. West Texas crude is in a bearish drop over the last 4 weeks of 22.5%. That's at the lower part of a range that could see a bounce this week. The heat map is mostly neutral, with strength in consumer discretionary, home builders, real estate, and some tech, with the big cap tech stocks having an effect on the XLK. Last week, XLU also strength and weakness everywhere else. International markets heat map was fading as well. We did see IEMG, the emerging markets ETF, at the 200 EMA. That might be an entry this week if we start to see some improvement. Europe and China were weak. The USMCA has been signed into law, though Canada and Mexico are slightly neutral to bearish at the present time. We'll look at some IBD 50 names. Most of them look okay, but there could be a little bit more downside if there's some more fear on Monday, so keep an eye on that. And we'll look at some Market Smith Growth 250 stocks showing relative strength near pivot breakout zones, and stocks in the top 20 volume percent gainers. AEMD looks really good, by the way. Make sure you check those names out as well. Bukowski has 5 of 5 green. That conflicts with his CPI signal, which has been red since the end of January, dropping to 0%, which is bearish, with 70 bearish patterns, 0 bullish patterns this week, and 84 patterns waiting for a breakout. Bottom line, there are still a lot of stocks that look pretty good, though we are watching with anticipation on Monday morning as the China stock market opens again for trading. Many people are expecting a drop. So we're bullishly optimistic but overly cautious to start the week. Just keep that in mind. We're still in day trader mode. We're waiting for opportunities, and we'll let you know when things look more conducive to swing trades. Just keep in mind that sometimes it's better to not trade at all. Starting off the week, we have the spiders in a descending pattern. We did stop at the 50-period moving average, the purple line. Friday bounced and closed a bit higher. RSI still shows signs that we could see further downside before reversing. If we do drop below the 50-day moving average, we'd need to see something like what we had back here in September. MACD was in a bearish cycle, eventually turned back up. We don't see that kind of situation yet, so for now it looks more bearish than bullish to start the week. For the last few weeks, we've been watching the XII ARCA Institutional Index to see what institutions are doing. These are the 75 stocks most commonly held in their core portfolios. For the past few weeks, we've been telling you look for red sticks. We got that last week in spades. Looking for a resolution, the 50-day moving average is right here at 1501. So we could test that level on Monday, most likely, depending on how the markets open Sunday night when the Chinese stock markets open again for trading after markets were closed due to the coronavirus. So we'll be very curious to see how institutions react on Monday. The S&P Equal Weight Index, on the other hand, did pull back to a 618 Fibonacci level, taking this December low up to the recent highs. Price action pulling back to the 4600 zone before bouncing on Friday. The thing that I'm very interested in is what this oversold indicator is telling us. We could see a trigger to the long side. Each time this is turned back up has resulted in a nice rally. In each case, each vertical signified an oversold condition where we got a trigger once the indicator started moving higher. So we'll see how this turns out on Monday. It's very fortuitous that we're sitting right at the 50-day moving average. Maybe that's an area where institutions decide to pick up shares. Again, we're only down 3.36% year to date from the 52-week highs that we reached 2 weeks ago. So there is a possibility we could see a short-term bounce. The Nasdaq 100 is also faring fairly well, pulling back only 3% over the last 2 weeks from that recent high as compared to the S&P 500. Volume was above average, so we did see a distribution week. MACD is above its signal line and starting to turn, but more bullish than the S&P 500. So if you're going to focus on any index, I'd look at the stocks on the Nasdaq 100 for a sample list. The Qs also held up very well. RSI is still above 50. It's holding at the 21-day moving average compared to the S&P 500, which tested the 50-day. 382 Fibonacci is holding. MACD is drifting lower. Volume did increase on Friday with a bearish engulfing candle, but it does look pretty good compared to the S&P. So I'll be focused more on the tech stocks and the Qs this week. Small caps unfortunately had the worst showing for the past 3 weeks. We hit that high at 170.36 and 3 weeks later we're down 5.88%. Small caps falling out of favor. This is a risk on, risk off indicator currently telling us to be cautious as we proceed into this first week of February. RSI continues to drop and volume is increasing. MACD is turning lower. Looking at the big board, New York Stock Exchange, more than 3,100 stocks trade on the exchange. We do see still more new highs than new lows. We remain above the zero line, as you can see. But the moving average is dropping. This is telling us to be more cautious for the past few weeks as the New York Stock Exchange continues to print red sticks as well. Looks like we're headed back to the 130 period moving average. That's 255 trading days rounded up to 260 divided by 2. That gives you the 130 period moving average. Looks like we're headed in that direction if institutions don't start picking up shares following whatever happens in China to start the week. In addition, breadth has pulled back. We have the S&P 500 in the upper panel, mid caps, small caps, and Nasdaq in the lower panel, all of them heading towards the minus 30 zone. This would be an opportunistic area. If we got down to that minus 30 level in the short term, we could see a turn in the bullish direction, which could have an impact on the S&P 1500 signal. We're starting to turn red here, which could give us a crossover in the short term if that does pass through the moving average. Histogram is already below zero, so this is a caution signal, early sell signal, as we saw with red sticks here as well on the S&P 1500. We also see breadth deteriorating in all three, the S&P 500, S&P Midcap 400, and S&P Small Cap 600, with a 90% down day on Friday. Thanks to Joel for this chart from Arthur Hill over at trendinvestorpro.com. So the takeaway here is we have at least 2 or 3 weeks of instability ahead, and we should plan accordingly. We have hit extremes that have shown promise in the past. Whenever we get to these minus 50, minus 60, minus 80 zone, short term, that tells you to look for a reversal over the next 5 to 20 trading days. Each time that's occurred, when we've moved down below minus 60, minus 70, minus 80, delineated with a box, those were reversal zones shortly thereafter. So depending on how China opens, there might be some optimism for the bulls this week. Fear indicators also spiked to highs. We had VIX pop up into the green zone, almost closing above 20, but it did fade towards the end of the day as the S&P 500 bounced at the 50-day moving average. So there is a possibility we could push a bit higher depending on the fear factor on Monday and Tuesday. So look for an extreme reading here for a fade the fear moment where price action invariably will reverse and turn back up if VIX gets back up into that zone this week. Skew is also shy of the 135 zone, so institutions don't appear to be actively hedging. They were back in mid-December, but those hedges unwound over the last month or two. So if we see any changes here, we'll let you know forthwith. The bond stock ratio also confirms that bonds are favored over equities short term, as this ratio in the bottom panel, the red line's moving higher back towards the moving average. We told you over the last couple of weeks, the fear and safety trade is in effect at the present time, which showed up in TLT as safety-minded investors chose bonds over equities. The TLT moved higher. I know a number of you in the trading room went long TLT last week. Congratulations. This weekly chart appears to be ready to test that 147.66 zone. Last week we talked about the fact that maybe this is another leg up and a move higher in bonds as junk bonds and high yield corporate debt yields move in the opposite direction. We see a test of the 21-day overhead. You know that I'm bearish when price action is below this level. Perhaps a test of this low this week with a trend break last week in the S&P 500 continues to print red sticks with junk bonds signaling more downside potential if we can't see a reversal back above the 21-day to start the week. So if you're bullish, you want to see a move back above the 21-day. If you're bearish, the equity markets, you want to see junk bonds continue lower Monday and Tuesday to confirm your trades. Currency traders were very apprehensive. Last week we thought the US dollar could break out of this descending channel. Instead, we got rejected, moving lower. This should have an adverse effect on gold and copper, the latter being affected over the last 2 weeks with a really nice waterfall event back down to that 248 zone where we could see a bounce this week. Been a lot of selling volume in copper. As a result, while we would look for the longer term copper chart to improve rather than take out these lows that we're looking at here, each time this has rallied, this was a forward-looking indicator. Note that back in 2009, this copper indicator, if you will, turned 3 months prior to the market actually bouncing. So this could be leading us lower, indicating that the economy might be slowing. I'm tending to disregard it in the short term because the building and construction group continues to show promise and is trending. As with 2016, the markets rose again. We faded off of those levels. We were looking for a breakout to begin January. Instead, we got this bearish price action. So look for copper to improve if you're bullish on the markets. And look for gold to continue higher if the dollar does fade back into that descending channel this week. Look for gold to break out. It's in an area of little supply, as you can see with volume by price bands. It looks like we're going to test the 1613, this level. Maybe we'll get that a spike up to that level on Monday, Tuesday, perhaps in response to what might be a bearish event on the Chinese markets when they reopen. And watch for crude oil to bounce at the lower part of this range that we've seen since May of last year. Very possible that we could see a return to a bullish trend in West Texas crude and Brent. So if that were to occur, that would be bullish for equities since this does have a positive correlation. Do note that this turned lower before the markets did, along with junk bonds and high yield corporate debt. So yields and crude would definitely be something you want to see a bounce in if you're bullish equities this week. The sector heat map also rotated a bit more into the oranges, a little bit less crimson reds. That said, we did see home builders outperforming last week. In addition, note real estate, REITs, technology, internet did okay. Semiconductors did pull back a little bit. Utilities outperform again, while the international markets continue to show more yellows and oranges. We did see a little strength in the South American countries and a lot of weakness, obviously, in the Southeast Asia countries. While sectors in the U.S. did reflect weakness, transports, materials, financials, energy, industrials, and healthcare were all below their 20 and 50-day moving averages, the blue and red lines respectively. While we did see strength in XLU, utilities, and consumer discretionary is holding up somewhat better. Real estate holding its 20-period moving average, as were consumer staples. To start the week, focus on the strong sectors and watch for more weakness in those that are below the 20 and 50-day moving averages. Maybe some opportunities there if we can see breadth improve. Here is the IBD 50. Do note price action in many of these names are still above the 20-period moving average, like Adobe, and real estate stocks like CB Richard Ellis, CBRE. Booz Allen is also above its 20-period moving average, as is Copart and Chegg. Many of these stocks look pretty good. EPRT, another REIT. REITs outperforming last week. Franco-Nevada with gold outperforming. Stocks like Lulu, how it handles the bullish 21-day moving average, I'm watching very closely. If RSI can turn back up as a function of price, that would mean we'd see a bounce. I'd really like to start a position in Lulu, though I'm in no hurry. So we'll wait for Monday action to see how the markets start off the day. Chinese stocks like Alibaba have actually been holding up fairly well, all things considered. RSI is near the oversold zone. It is below 50, so we have to respect the fact that price action is below the 21-day. Any bounce would most likely get rejected at 212.50 and 214.67, the 9 EMA and 21-day respectively. So depending on what happens Monday with the Chinese stock market when it opens, maybe we get an opportunity to buy Alibaba, while stocks like BlackRock, which do hail from the financial sector, XLF, as you noted before, is below the 20 and 50-day moving averages. BlackRock is showing relative strength, manages to hold up above its 21-day moving average. It's in a bullish trend. RSI is still above 50. This company manages high net worth individuals and corporate and institutional assets and alternative investment products. So at a minimum, we need to see a bullish day on Monday. A safer entry would be Monday's bullish, and then Tuesday winds up being a follow-through day for a test of those recent highs. Dexcom in the glucose monitoring and diabetes business continues to show relative strength. This one showed up on the MarketSmith Growth 250 relative strength scan, holding the 9 EMA, exhibiting relative strength as RSI continues to move higher. MACD's flat, and we did see increasing volume on Friday while the markets were moving lower. So watch Dexcom, DXCM this week. In addition to DR Horton, which was on the watch list several weeks ago, into the last couple of weeks, if you did take positions off into that strength last week, we're looking for the 9 EMA to hold. If that doesn't hold, we're looking for the 21-day. I do think the stock will probably continue higher, but I want to see the evidence first. So watch this one. We'll look for another entry on this DR Horton home builder from the real estate group. In addition to stocks like Essential Properties REIT, these REITs continue to show relative strength. While it did move a bit lower on Friday, we're watching for price action to remain above the 9 EMA. Any pullbacks to that level, we'd be looking for an entry. Only if buyers show up, along with plenty of the gold stocks that have been looking very strong lately. Franco-Nevada Corp continues trending. I wouldn't be interested in buying it up here, but I would be interested if it pulls back to the 9 EMA like it did last Tuesday. Find buyers. Volume has been above average. Relative strength is showing muscle in the upper panel, and MACD's above its signal line, not showing any signs of slowing down in the short term. So look for some of the competitors in the group too. There's a lot of other names that look strong as traders continue to look for safety when they buy these stocks. We're also watching for Netflix to eventually resume the trend. It's holding above the 9 EMA for the past week. Each time it came down to the 21-day on Wednesday and Thursday, buyers stepped up. I thought we might see a follow-through last week, but I guess the options expiration was too much for Netflix to continue higher. Volume did taper off on the flag, so that's what you want to see. You don't want the opposite, like we saw back here on the week of the 21st, where the pullback ensued on much higher volume. Exactly the opposite occurred last week. So that's a good thing going forward, and we'd look for increasing volume and look for high R-vol to start the week Monday and Tuesday. Stocks like Paylocity also improved last week, continue to trend, relative strength, RSI showing muscle, MACD somewhat flat. This cloud-based provider of payroll and human capital management software solutions for medium-sized companies continues its bullish trend. Relative strength line is climbing. It does have earnings this week, so be aware of it. All the while, stocks like Planet Fitness, which we took from a Monday, we had a nice swing on. We took some profits into strength on Friday. I'd like to get back into it if we get a little dip back down to the 9 EMA, and that does hold. It's been in a nice bullish trend along the 21-day moving average. With earnings out at the end of February, we do have this big cup and handle pattern looking like it's going to follow through and break out on the daily. Relative strength line is climbing. Annual sales and earnings are increasing. Decent IBD metrics. On the weekly time frame, it's a little bit easier to see this very large pattern and potential for this stock to continue higher. Cup and handle patterns are continuation patterns after all. And we can see the company continues to beat in earnings every quarter as they continue expanding their business footprint throughout the United States, Puerto Rico, and Canada. Square also performed exceptionally well last week to start, and then Thursday and Friday started to flag. We did take some profits midweek, traded it early in the week, looking for price action to stabilize here. MACD's above its signal line, and volume is tapering off as this flag forms, so that's the best scenario. We look for breakouts to come on high volume like we saw to start the week Tuesday and Wednesday for potential re-entries on high relative volume on Monday or Tuesday. Spirit Realty, SRC, another one of those REITs that's outperforming. We managed to stay above the 9 EMA. Relative strength, RSI, is just below 70. MACD's above its signal line. Volume has tapered off somewhat. So we'll look for a follow-through on a lot of these REITs this week, while stocks like StoneCo continue to show a bullish trend. Not a lot of momentum, but the trend is intact. a company known for its financial technology solutions for merchants and integrated partners in Brazil, headquartered in Brazil, highlighted by a nice weekly trend that just continues to push higher. With stocks like XP, also a Brazilian-based company that has financial securities brokerage and low-fee financial products and advisory services, a new IPO that's looking pretty strong relative strength-wise. If we start to see a push towards a 41 level, 42, this could be attacking that 43.50 zone in the short term. And finally, we have a Yandex, which has been continuing with this trend. It did see a little selling on Friday. Watching the 21-day, first a bullish day on Monday, a safer entry Tuesday would be a follow-through day like we saw here off the 21-day, the second day being the safer entry. We also have some candidates in the opening monologue that showed up on the MarketSmith Growth 250 Relative Strength Scan, as well as these top 20 volume percent gainers. Make sure you check those stocks out as well, as many of them, like Adobe, continue their bullish trends. Candidates for follow-through: Allegion PLC, a provider of mechanical electronic security products in the Americas, Europe, Middle East, India, and Africa, in a nice trend. AEP, the utilities group, was very strong last week. This one continues to trend. Also check out, if you have a MarketSmith subscription, the competitors in the group, all showing high relative strength numbers. Potential candidates: ELP, NEE, N-E-E. I know Robert Kaplan likes to trade this one from time to time. Copart in a nice bullish trend, another relative strength name. Five9, a company that develops cloud-based customer contact software, assisting contact centers and customer service, sales, and marketing. You can see this is in a very nice bullish trend on the weekly time frame. Relative strength line is climbing, looking for a breakout in the short term with earnings 3 weeks out. Kansas City Southern and many of the rails look very strong as well. Some of you traded this one over the last couple of weeks. The Nasdaq Inc. has a stock, NDAQ. That one also showing relative strength as it blasted higher over the last week. Norton LifeLock looking very strong, showing potential for a breakout. This double top, fairly inexpensive name. Look at the volume showing institutions have been picking up shares. Something to keep in mind as the number of institutions continue to climb. We did see a little bit of a taper last time around, so when we see this updated in March, that'll give us an idea what institutions are doing. For now, this looks pretty strong. It's a trending technology for customers looking for network security, storage, and management applications for consumer enterprises. Stocks like Ring Central continue to trend higher as well. Additional utilities like Aqua America, WTR, flagging, looking for maybe a pullback first and a continuation out of this cup and handle pattern and a follow through. In addition, there's some names in the above average volume scan that I like to point out that look very strong. You can pause this if you like. With AEMD, the one that's really interesting to me this week, it develops medical devices for the treatment of infectious diseases. The key word being medical devices. So this company might partner up with a vaccine distributor that finds a cure for the coronavirus. It's a cheap stock, just something to keep on your radar. Nothing that I would put a lot of money into. Just keep an eye on it. And remember to check out the competitors in the group listed here as potential trades. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com on February the 2nd, 2020 with your weekend video newsletter. I'll send out a watch list later tonight around 11:30 on the East Coast, 8:30 on the West Coast. So be sure to look for that in your inbox. Bottom line, we're watching how the markets react to the China markets opening again. So trade with caution and with a day trade mindset to start the week. Take care. I hope this helps, and we'll talk to you soon.